be recording. Yeah. Okay. So welcome to our session. So today we're looking at property and investing in property and that kind of a thing, and the concepts that one needs to adhere to in that regard. But I think before we go into the concept of property and property investing, I think I need to do something, which is we're gonna discuss the concept of recession and depression. I think I should do that first, and then we'll move into property and property investing. Okay, so let me just do another slide first, and then we can come back to the main thing a little bit later on. Okay, so we're going to talk about recession and depression and what it means for businesses. Now, you might be thinking, why am I talking about this? Because the reason why I'm talking about recession or depression is because the state of the economy is a critical ingredient in how we invest, and especially as it relates to property. If the economy is good and there's growth, you will get good prices. But if it is not doing very well, you're not going to get good prices, and you may have a situation where you have what is called negative equity, or you may have a situation where you have positive, astronomical or very, very high positive equity. We're going to talk about the concept of equity if you are unfamiliar with it. But let's just look at this graph. Let's just grapple with the principles here. Now, on this graph, we can see here, these are what we call the various peaks. Some experts call it the peaks. Some experts call it boom. So peaks or boom. Now, we're starting in the 1800s, and they're going to move ourselves into our current situation. So the first, in the 1800s, steam engine and cotton was the drivers to economic growth. So the economy, the main thing that everyone was doing, or most major developed economies were doing, was steam engine. They were making steam engine, and that propelled the economy into a boom. And then after the boom, we have a trough here. So it basically cools down and drops. And then we have railway steel. Now, railway steel, again, you have the steam engine and railway and all of that stuff, So in the 1850s, that was the main drivers of economic growth. And then we have electrical engineering and chemistry in the 1900s. Those were the drivers of economic growth. Then we move on to petrochemical and automobiles, in the 1950s. So again, that just after the Second World War, that was the major drivers of economic growth. Then information technology in 1990. Now we are here in the 2020. I would say the major drivers right now is social media. Social media is one of the key drivers. The tech and tech companies tend to be the main drivers. Right now we're using Zoom, which is one of the emerging technologies in recent time, and it's quite pronounced now due to the pandemic. And so therefore, social media and tech are the main drivers, So you have talked about the Zoom, the Facebook, the LinkedIn, and all these various social media platforms. Now, so by the end of the session, you should get a better understanding of recession or depression and what's the meaning for business. So I'm going to look at what is recession and what's depression, and the effect on, I'm going to tie it into the concept of property. But let's first of all start off with defining what is a recession. A recession is a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 successive quarters. So it is important to note that the GDP, which is the gross domestic product, which is the aggregate output for any economy, either the economy or an individual, The GDP of an individual is the salary earned over a particular period. It's the gross salary, which means you don't necessarily take out all the various expenses. So the concept of gross is before expenses. And the same idea for the economy is the gross domestic product is the aggregate economic output in financial terms over a particular period. Now, according to this concept of recession, it says there needs to be a fall in the GDP in 2 consecutive quarters. And quarters here we consider to be every 3 months. So January, February, March, so quarter, etc. We're going to look at it in graphically in a minute. In terms of depression, and depression is in economics, a depression is a sustained long-term downturn in economic activity in one or more economies, and it is more severe economic downturn than a recession. It is a slowdown in economic activity over the course of a normal business cycle. So a depression is a prolonged, it's an extension of a recession. So a recession is 2 consecutive quarters. So a prolonged downward trajectory would be a depression. Now let's have a look at some, let's look at the practicalities of this. Now here, remember we spoke about quarters, right? Yes, I think we need to talk, so if you are not clear, if I'm going too fast, it is important for you. You can unmute yourself. If you have a quick question, unmute yourself, and then we can, so that we're connecting as we go. Now here we have January, February, March being a quarter, April, May, June, another quarter, July, August, September, another quarter, October, November, December, another quarter. So I've basically divided the year into quarters, and I've captured economic growth over the period. Now, we say here that in the first quarter, which is January to March, the economic growth here is 1%, which means the economy grew by 1%. Whatever it was before, it expanded by 1%. In April to June, it expanded by 2%. So much more than the previous period. Again, it expanded again, but by 2%. And then it expanded again by 3%. If we were to do an average of the 4 quarters, we will see over the period, the aggregate economic growth was 2% over the 12-month period. Now, this is what happens in a normal economy. It is important to note that this situation gives us a benchmark of what is supposed to be the case. Now, let's have a look at what will happen if this is not the case. Now, let's say in January, February, March, economy expanded by 3%. But in April, May, June, the economy contracted. So it's doing the opposite of expansion, but contracting by -1%. July, August, September, it contracted by -2%. October, November, December, it contracted by -3%. If we were to add this up and find the average, the economy as a whole contracted by -0.75. Now, let's have a look at the concepts here. Remember we said that a recession is what? I want you to talk to me. What's a recession? Luik, what's a recession? What did we say a recession was?
The downturn over a specific period, over 2 following quarters.
Okay, so it's the downturn of economic growth over 2 quarters, right? Good. All right, so can we observe a downturn in between January to March? Can we observe a downturn between January to March?
No.
No, there's not a downturn there. Can we observe a downturn in between April to June?
Yes, need to ask it. Because there's a little bit more to it than that. I'm going to show you 6 question categories. Each category, you choose by 1, 2, or 3.
Roses. Let's 1 sec. Okay. Can we observe a downturn between April to June? Yes.
Yeah. Yes.
And July to September, there's another one.
Yeah.
Yeah. But and then October to December, there's another one. So we can see here that the recession actually took place in between where? What points can we see that the recession taking place? At what point do we see the economy is in recession?
Between April and September.
Okay, yeah, so between April and September. So over those 2 quarters, which is a 6-month period there, we can say the economy is in recession. But when is it in depression?
From let's say April to December.
Yeah, so April to December. So we would say when we consider December, it's in depression. But June and September, we see the economy. When we consider between June, which is the first June, rather April to September, it's recession. But when we consider December, the 3 downturns, we can say that the economy is in depression. This is critical because when the economy is in recession going into depression, what happened is there's a cooling off in terms of house prices. Right now, what is happening is there's heat in the housing market, but that heat in the housing market will not necessarily last. So we will see an inverse at some point because the steam is going to come out of the economy as it enters into the next phase of this lockdown and the economy again further contracts. Okay, so let's go a little bit further. Now let's look at some statistics over the last few decades, from the 1960s all the way to 2020. Now it is important to note because in the gray area, we can see the various times the economy contracted. And we would consider these points to be recession. So in the 1960 was the first recession. Based on this, 1960, like 1963 thereabouts. The 1970s, another one. I would say 1980, 1975, somewhere thereabouts. 1980s, another one. 1992, somewhere thereabouts. Yeah, all these various points. So we can see, as I said before, the recession, we can record 1960, 1970, 1975, 1980, 1983, 1993, 2004, and 2008. Now, if you look at this graph carefully, you can see almost, and there are some outliers in it, but we can see almost every 10 years, in some instances, 5 years, but generally about over a 10-year period, 7 to 10-year period, there's a drop in the economy. So if the economy is growing and you're seeing that, oh, okay, what's going on? Over about a 5 to 10-year period, you would see a contraction. So therefore, the economy is going to correct itself. So more likely you might have a recession or a depression taking place. So we can almost estimate that 2020 is going to be a recession, as we see, and this is due to COVID-19. But we can almost forecast that by 2030, we may have another one. If we're considering every 10 years, another one, 2040, etc. So we can almost assume that. So every 10 to 5, 7 years thereabouts, 5 in some instances, yeah, the economy contracts. And from an investor perspective, and if you are going into property, it is important to note this. So you know when you're investing and what the state of the economy is at the time you're investing. Now let's have a look at the Great Depression. Now the Great Depression took place in 1929. Okay, so if we look at the 1929 here, we can see that at that point, the economy was, above, I would say, above ground. And then 1930, 31, 32, the economy consistently contract. Now, in light of what I said before, can I ask someone else? When was the economy in, when did the economy get into recession? Rose? When did the economy go into recession? Or are you not able to? Jean, you want to answer?
You're talking.
Okay, yes. When based on the statistic here, is the economy in recession? We're looking at years here, but normally we tend to use quarters. But here, yeah.
So I'm looking at 31, 33.
Yes. So yes. So we can almost say that 31, because the economy dropped in 30. It's a 29. It was above ground. Then 30, it dropped. And then 31, it dropped even further. So by 31, we would say that the economy is in recession.
Mm-hmm.
By 32, I would say it's in depression. It continued in depression in 33 and recovered 34 and then continued all the way up. All right. So, but it is important to note this because there's a lot of critical things happening here. Because what is happening is that from 1929 to 1936, how many years would that be?
7.
From 1929 to 1936 is how many years?
7.
That's 7 years.
7,
So
yeah.
it took 7 years from 1929 to 1936 to actually correct, to recover to where it was. That's important. And it actually also took 3 years for the economy to actually fully bottom out or just, you know, hit the ground, hit its lowest point, technically. All right. So that's also important. Now, would that be the case with this recession that is taking place currently? Recession/depression? We do not know. But experts are now concluding that it is possible that this downturn will take years to recover to where it was. And it's now, you know, increasingly likely that it is not necessarily going to be a V shape, but there's going to be more of a U shape recovery. All right. Okay. So so again, the most important thing we can know, it started in 1929, ended in 1933. Then the growth again was 1936. There was a second drop again, 1938. All right, so that's important to note. Okay, so again, we can say, you know, it took 7 years. I would say, as I said before, the business cycle tends to last over every 10 years, 5 to 10 years in some instances. There would be a correction in the growth of the economy. If the economy is growing, you know, a 5 to 10 year period has, you know, from 2008 until now is you know, that's a 12-year period. So we kind of had a slight over the cycle, but generally over a 10-year period, you're more likely would see a downturn in the economy. So the business cycle, and we can see that it holds true. And the recession creates opportunity for business to innovate. So it's almost a reset moment. Some people are on furlough at the moment. So you can get an opportunity to just kind of, okay, all right, fine. What's my strategy? Reshape, refocus and go again. And again, we can highlight another thing that in 1930, there was a high birth rate, okay? So when a recession, when the economy cools down and, you know, there is a downward sloping in the trajectory, it's likely that, you know, when people are off, the birth rate might increase. Now, let's have a look at this information here in terms of house prices, and we can correlate it with the previous graph. We can, let's just look at it first. So here we can see house prices growing. Let's say in 1981, what's about 5%. That's low again, 2% thereabouts. 1989, it's very, very high here. So the growth per year was over 31%, quite high. Then 1989, 1991, there's negative growth. And we said that obviously it seems as though the economy was in recession, so there's negative. So if you bought property here, you're more likely you're gonna have no equity in it, or the margin of equity would be very small. And then there's a recovery here. 2003 was quite good. And then again, there's a drop in 2008. We know what happened in 2008, the mortgage crisis in the United States, and that extended into other places in the world, and also affected the countries like the UK, etc., and other first world countries. Now let's have a look and compare. So we're looking at 1981. I got information from 1981, and we see 1981, according to the other graph, was a recession as well, right? So we see the downturn actually taking place, so we can correlate that. The next one happened in 1993, somewhere thereabouts. We look on the graph, 93. Again, we can see that there's a similar You know, actually, it actually took place before, between 89. So 89 to 93, it's all negative. And then we have 2004 thereabouts. See, 2004, there was a drop from a high of about 25 or 27% annual growth. And then in 2008, again, we can see here a significant drop, which correlates again with a recessionary graph. So we can see that when there's a recession, it holds true that the housing market is going to be impacted. Right now, it is not it's the early stages, but we wait and see, and we'll likely see a correction in the market at this point. Okay, so we've looked at what's a recession. I'm sure you are clear, hopefully. What's a depression? We've looked at it in terms of the concept of housing, and hopefully this adds some clarity. Now let's move on to the next slide, which is the main thing. Any questions though? Any questions?
No.
In light of the first PowerPoint slide? No? Okay,
No.
good. All right, good. All right, so let's go into the main meat of the matter here in terms of property investing, the recession-proof way. Okay, so the style of the presentation, initially, we meant to have an introduction for 10 minutes, promotion for 10 minutes, and then core content for 50, question at the end for 10 minutes, and then we'll say goodbye for 10 minutes. Now, I've we might be slightly off because we've taken about half an hour on the first one, but we'll be able to cut here and there. But I think we're still on track to be able to complete all that is required. Okay, who am I? My name is Sean Fuller. I have an MBA in finance, a BSc in management. I have an advanced diploma in CIMA. I have a level 3 qualification in teaching. I've been working in accounting and finance for over 20 years. I've also taught at top university in the UK for over 10 years. And I've worked in management accounting for over 10 years. I've worked in areas like business analyst, property investing, and management, business consulting, and financial advice for several years. My passion is business and finance and entrepreneurship. My hobbies, I like playing basketball, football, cricket, athletics. I like watching athletics. I'm not able to do it at the moment. I like traveling, and I also like to study the Bible and, you know, look at the word. Okay, so these are some of my passions. Now, currently I have 2 books on Amazon read this particular topic in terms of investing in property. Now I'm working on getting hard copies. So if you're very interested in, you know, if the soft copy is not your thing, I'm working on getting hard copies. So that is coming out by the end of the year. I should be able to provide you with hard copies. But if you have access to Amazon Unlimited or a Kindle, you should be able to download. If you have Kindle and you have Amazon Unlimited, you can actually read the book for free. But if you so desire to actually purchase the copy, you can download it through your Kindle device, you know, providing you've purchased it. It's around £8 to £9 thereabouts, based on the exchange rate. I think we started in US dollars, so you know the exchange rate is moving up and down. Sorry. So you might have a difference, you know, it may hover between 8 and 9 thereabouts. Okay. In terms of the content of the book, we go into property investing from the household perspective, and then we move on to investing of buy-to-let for buy-to-let investors. Then we move on to property investing, the cons or the good news. And then we move on to ways of investing in property and the drawbacks to buy-to-let investing. Okay, so these are some of the things that you will cover in this book. Rules, wait to be acknowledged. You know, raise your hand to ensure that, you know, we keep the time. You know, try to not to be disruptive and respect each other. Some people are knowledgeable, some people have a background in finance, some people have bought properties before, some people have not. And so therefore, you know, the knowledge level is may not necessarily, you know, maybe have a normal distribution of the knowledge. So please be patient with others who may ask questions that you are privy to the answer. So therefore, you know, maintain that level of respect. Ideally, I'd rather not entertain questions while the presentation is taking place, but if you have an urgent question and there's something complex, it is important that you kind of indicate to me so that if you want me to, you know, go over for clarity, then, you know, we're able to do so. Yeah, introductory questions. I did ask earlier, you know, if you had any questions. Yeah, so generally just try to be nice. No discrimination, insulting behavior. And ideally, if you want to exit, say that, you know, you want to leave, you know, you can indicate so that, you know, we're all aware that you so desire to leave, okay? Because this is a free session. So, I mean, you're open to you know, do as you please in a way. So our aim is to get a better understanding of property investing. So we're going to look at how do one invest in property? What are the strategies? What are the countries to invest in terms of property? And then we'll conclude. Now, let's start off by looking at the concept of the various categories of property. So first of all, we'll look at what is called residential property. Now, residential property is where you buy a property to live in. Okay, so that's your main home. You buy it with the intent to live in. Then we move on to commercial property. So this is where you buy a property, but it's for business purposes, which means its main purpose is to sell goods to the public. So that's the main aim of that kind of property. Then we have the private investor, and private investor will buy property and then let it to others. You know, so we call it, the Americans would call it investment property. Or sometimes the British also call it investment property, but or in most instances, the British tend to say buy to let investment. So that's the term used. Okay, and then we have land. Okay, so that is where there's, you know, nothing, so undeveloped. So it's the land. Sometimes we may have a situation where you have a property that has been so badly damaged that the value is nil to a degree. And so the land is sold. There's not much of a value on the actual building itself. So that also could be considered to be land. Okay. Now, in terms of pricing, and then, you know, this may vary based on the country you're from, etc. But we can consider in terms of residential property, let's say for the average consumer, between 300,000 to 2 million US dollars. In terms of commercial, we are looking at 1.5 to 10 million. And then in terms of private investing, we are looking at 300,000 to 5 million. In terms of land, we're looking at 50,000 to 5 million. Again, you know, it could go higher or lower based on the country, but generally, I would say these are some of the main figures that we can consider. Now, in terms of property, we also need to consider, you know, the deposit. So generally, if you were to look at a property for 300,000, you would need to put a personal amount, which includes, you know, fees, etc., of about 45,000. And the top end of 2 million, you would need 300,000. Okay, so 2,300,000, 300,000 property value, 45,000. And then you need to get finance on the lower end of 255,000 and the top end of 1.7 million. In terms of commercial property, looking at 450,000. And there's some differences there. We're going to talk about it later, to about 3 million in terms of the actual cash that you need to have. And for investment purposes, we're looking at the 1,150,000 and then 7 million. For private investor, again, looking at 30,000 from your pocket, 90,000 from your pocket, and 1.5 million. And then you need a bank to finance 210,000 and 3,500,000. And in terms of land, there's an inverse in terms of land, because land does not necessarily give you a return except you develop it or do other things to it. And so therefore the capital outlay or the amount that you put in as an investor is significantly higher, and you borrow slightly less. So, so from an investor, you would need to, if you're buying a land for 50,000, you might need to have 40,000, and then the bank will, finance the 10,000. And then in terms of the top end, looking at 4 million, and then the bank will finance 1 million. So more of 90%, if you're buying land, is generally okay. As I said before, because it's, it doesn't generate an income, and so therefore the only thing you can get is when the land appreciates in value over time. Okay, so what are some of the strategies in terms of property and property investing? So you could buy property for a good price, hold, and benefit from the gain in value. You can also buy an auction property at a discount and fix it up or sell it, or you can also rent it. You can rent and sublet to others. You can buy, break down, clear, and start again with new units. Now let's look at the math of it. So let's say you buy property for a good price. The initial investment in a property was 250,000 US dollars, or you can say 250,000 pounds. After 10 years, the property increases in value to 500,000. So we can see here that the property has doubled in value. So there's a gain over the period of 250,000. The initial investment was 250,000. That's in a good economy, sorry. If we have another situation where in another state of the economy, the initial investment of 250,000, after 10 years, the property is actually worth 150,000. Here we would see that there's a loss. So the first one, remember we spoke about recession, depression. In a good economy where there's a boom, there's likely that you'll have an increase or doubling of the property price over a decade or even two. But in a recessionary economy, we would see a downturn, and then you're likely to have what is called negative equity. And so we see a loss for the homeowner here in this situation. Now, let's look at buying at an auction. Now, let's look at the math of it. Let's say if you go to an auction and you buy a property, initially as you buy the property, you need to have 10%. So the property is 200,000, so 10% of that is 20,000. You need to be able to finance the remaining 90%. It is wise for you to do due diligence in terms of, checking the property before, getting any history on the property, the bathroom is working and all the various things. You might have it not necessarily in good condition, but you want to know the level of damage you're working with. Because in some instances, the bank would not finance it if things aren't working to a certain level, or if it doesn't have a toilet, etc. There's some factors that one needs to consider. In terms of the repair, you may need to have about 30 to 50,000. So the total spend is about 250,000 altogether. And then if the fair value of the property after you've spent on it is 400,000, which means that's the market value of the property, then you benefit from a gain of 150,000. So that is good. This is what property investors do. They go to auction, they get a property, they try to get it financed, and then they fix it up and sell it on, and they try to gain from the property price, the fair value of the property being higher than the build cost as well as the acquisition costs or acquisition price. Okay, so let's move on. Then there's another concept here of Airbnb. I'm sure you've heard about it, right? This is where you don't necessarily need to own the property, but you can basically rent the property and then sublet it. So, you rent a property and it's a 5-bedroom, You find what the agent's fees and all the various costs, and then you rent the rooms out. So let's say you were to rent each room for an average of 700. Initial cost of the property from the initial landlord was 2,000. And so at 700 times 5, that's 3,500. The other fees you may need to pay, agents' fees, etc., works out to be about 500, and therefore you have a profit of $1,000 or 1,000 pounds. You can also increase your profit by changing a 5-bedroom house into a 7 or 8-bedroom house by taking out the lounge area or the living room area and kind of transform it into a bedroom. And so you just have bedrooms solely. But again, you'd need to have other things in place, like, appropriate bathroom facilities so that it's not overcrowded. Then we can move on to buy, breakdown, and you can build and building new units. Now, this is another concept where you buy the property, you break it down because it's not in a repairable state. Again, you need to get planning permission and to see whether it's a listed building, etc. But in some instances, you're able to break it down, and then you're able to rebuild. And some people rebuild initially it was 1 unit there, and then they tear it down and rebuild. And the rebuild costs, let's say, is 500,000. And so therefore, they now have 2 units instead of 1. And say in a good market, each unit works out to be at 700,000. It's freehold, it's detached. That's 1.4 million. And therefore you have a gain there of 600,000. So this is an opportunity again for one to gain from property, but you would need to have skills in terms of contractors and dealing with the contractors, or some building skills and also interior design skills to be able to net a profit once the product is finished, so that people are attracted to what it is that you have done. Now, any questions so far?
No, all clear.
No questions so far. Okay. So some of the countries with yes, Rose?
No, I'm just saying no question.
Okay, good. Okay, some of the countries that property markets are heating up, I would say, specifically in the UK, London, it's known for its, the property market here is hot, and there's good yields. And New York City, to be specific, Manhattan is the prime area. Canada, you have the Toronto, and then Australia, you have Sydney. So these are some of the areas. Now, there are other places in the world where you may be able to get good deals, where there's good appreciation. I think in the Asian region, Hong Kong, but I think there's a bubble there. So, you have to think about other factors. You may be able to get a return, but you need to also think about the state of the economy as well, and would the growth last? Now, let's further look into the mechanics. Let's say you were to buy again a property for 300,000, and after 15 years, the property is worth 500,000. Now, this is important because we're going to move into the concept of equity. So some people hear the term and they're not familiar with it, but equity is a very, very critical part of the whole concept of property and property investing. So let's say after 15 years, the property is worth 800,000. So the gain over the period is 500,000, okay? Now let's look at the mechanics of this. So you bought a property for 300,000, but there was a deposit of 30,000. And then there's fees. Now, the fees we consider to be what's called a sunk cost. We cannot capitalize it, which means that we're gonna also look at the balance sheet or the financials of the property moving forward. we cannot capture the concept of fees because it has to be absorbed by the buyer, as a cost in their investment. So you're not going to be able to track it. So the mortgage is 270,000. So the main figures we can consider here is a 300,000, the deposit of 30,000, and the mortgage of 270,000. So after 15 years, we said that the property is 800,000. Now let's look at this concept of the accounting equation. Now, because my background is accounting, I love this because accounting equation allows us to be able to actually understand what is going on behind the scenes. So the asset here is 800,000. The liability, which is the debt, which means the bank actually is the one that is financing this side, which is the mortgage, it's 270,000. And therefore the capital is 530,000. Now, I would like for someone to tell me, let's just see, what would the initial equation look like? At the end, the asset value is 800,000. The debt, providing the mortgage has not been paid off, it was interest only, is 270. And the capital is 530. What was the figures in the initial mechanics of the purchase? What do you think the figures would be? Anyone? Anyone?
The figures have gone down, so I can't. I'm just thinking, so the figures, you'd have the 270, which is the cost. You'd have the 30,000 that you put down.
One sec, let me just move this out of the way. Okay.
Yeah, I can't see.
All right, let's just write down the equation. It says asset is equal to what? Anyone remembers?
Liability plus capital.
Liability plus
capital.
Plus capital, all right? So this is liability and this is capital. All right? This is very, very fundamental. If you go to invest in property, you need to remember this because this is where you can see your growth or the change in your situation over the period. We said initially the figures were, we bought the property for 300,000. The deposit was 30,000. And therefore the mortgage was what?
270.
Yeah.
270,000. Can you tell me how you could either have it be in pounds or dollars? It doesn't matter. So this is the deposit. This is the price. And this is the mortgage.
But what about the fees?
I said that the fees is what is called a sunk cost. The fees is sunk cost. We cannot capitalize it. It cannot be capitalized.
Oh yeah.
That's that's burning your pocket and goes, and that's it.
Okay.
Okay, so how would I put this in the equation?
So the liability is 270, isn't it?
Okay. Should we start or we start in the middle? All right, let's start in the middle.
I'm just thinking.
Okay, you start in the middle. You don't start at the. Okay.
Your capital is 30.
30,000.
Which is your deposit, isn't it? So then the asset is 300,000.
And then and what?
The asset then would be 300,000.
Exactly. So asset is 300,000. Are we good with that?
Sorry, my brain kind of work a different way. So
yeah, are we good with that?
Yes.
Is that making sense to everyone?
Yeah.
Yeah, good. Now, let's see how the situation changed. Asset now, we said after 15 years was what?
It's 800,000.
800,000. It was an interest-only mortgage, so therefore the liability was what? Is now what?
It's still going to be 270.
Mm-hmm.
And what is the capital situation?
Your capital is now 530, isn't it?
Yeah. Okay. So what can you observe?
That over the 10 years,
Yeah, over the 15 years.
over the 15 years, you have a capital gain of 500,000.
Very good.
Mm-hmm.
There's a capital gain of 500,000.
Because the 30,000 is what you already had.
Good. All right. And that is so fundamental. That is so fundamental. Okay. As an investor, that is what you are key. That is what is critical to you. From me as an accountant and a finance person, this is also what's critical to me. The movement in equity or capital is the key indicator of your situation over a particular period, and not necessarily the change in asset, because an asset value could change significantly, but the equity, which is the capital situation, is what you measure over a particular period. And we see here that this it grew by 500,000, so it has grown significantly. If you were to look at the math, do you want to look at the math of that? Let's try to look at the math of it. Let me move this. Let's do, if you want to look at the math, let's mess around with the math. So it's now 500,000. And we're going to divide that by what? 30,000, right?
Mm-hmm.
How many times has the 500,000 grown over the period? Hello? Anyone with me? 500,000, how has the capital value grown over the period?
You're looking over the 15-year period.
Over the 15 years.
Yeah.
What's the rate?
So about 30,000, isn't it?
Yeah. So what I did is the 500,000 divided by 30,000 gives us what?
They give you the
16.67, right?
Yeah.
yes.
So your capital grew 16, almost 17 times over 15 years.
Yeah.
Which means technically every year it grew by 1%. Is that it?
Yeah.
More, yes. See, yeah.
Approximately.
Mm-hmm.
Yeah.
All right. Which is quite good. Which is generally good. The aggregate, input of it. Yeah, so it's slightly over 1, but that is good for any, in property terms, I would say it, we would like something a little bit more, but generally, looking at your performance, it's good. It's 16 times over the period. Okay. Actually, sorry. Now, if we were to look at, let's go a little bit further. There's something that we didn't observe. If this is 16 times, right?
Yeah.
If we were to actually, it's not actually 1%. I'm missing something here. What, can you tell me what I'm missing? If I were to look at a percentage of this, it should be actually 160. Let me look at the percentage of it. If I were to look at the percentage of it, it should be something totally different. Let's divide it by 500,000. That's 0.6 multiplied by
100. 6%.
Okay. Okay. Yeah. So that's 6. That's 6%. So technically it is 6% of the total growth, the total figure. But if I were to look at it in another way, the 16 or 17% is actually 1,700. I'm messing. Let's not mess around with the math of it. Let me just go back. 500 divided by. I'm gonna do it the other way instead of what I did initially. Divided by 30 is 16 point. If I were to multiply that by 100, I think this is the better way to do it. Actually, it's 1,666. And if I divide this by 15, it's actually 111%. So every year I made 111% return on my capital. That's the way to do it. Is it making sense to you? Have I lost you?
You've totally lost me, but I get.
Yeah, I'm lost as well.
Okay. All right. Okay.
Maths wise, I know where we've ended up, but maths wise, you've kind of lost me. But
okay. All right. Let me. Okay, maths wise. Okay. All right. So we know it's 17 times. Okay. All right.
Yeah.
Let me make it a little bit more simpler, because the objective is to make sure I'm with you and you're with me and we are with each other. I'm gonna erase this. Okay. All right. In year one, I put 30,000, right?
Yeah.
That's year one. Okay. Are we good with that?
Yep.
But in year 15, I have 500,000. 500. Oh, 530,000.
Yeah.
Yeah.
Mm-hmm.
So what I want to know technically is how many times this 30,000 has grown over the period.
Mm-hmm.
Yes? Isn't that what I want to know?
Yes.
yes.
Yeah. And let's just look at the basics of it. 30,000 times 2 is 60,000, right?
Mm-hmm.
Yeah.
Yeah. Okay. So so we know 2 times is 60,000. But this one, if we remove the 30,000, We know the actual growth in itself is 500,000. But how much of this is in this?
So that's one.
So we said it's 16.
Yeah, it's a 16 point something, which we could almost say is 17%, 17 times, right?
Yeah, because 13 to 50, 120, 13 to 206, yeah.
Yeah, so 17 times. So if it's 17 times, it means that at least every year, my growth was 100%. 30,000, I was growing my initial investment by over 100%. Because the initial, let me use another color.
Initially, it's 30,000.
The initial is 15 years, isn't it?
Yeah, 30,000 over 15 years.
Yeah, it's 15 years, right?
Yeah.
15 years. So, and in 2 years, I made 60. And if this into that is 17 times and it's 15 years, it means that even after 15 years, I still have 2 left. Right? So therefore, it must be that I'm still doubling 100 and a little bit every single year over the period.
Yeah.
Isn't it?
Yes.
So therefore, there's nowhere you could get anything like this. That is why property is so fantastic as an investment, because there's nowhere you could get over every year 100% return on your investment every single year consistently for 15 years, except through investing in assets like these. All right. Wow. So I hope, have we closed the gap on the concept of clarity? Have we closed the gap?
Yes.
Okay, we've closed the gap. We've closed the gap. All right, good. I'm assuming that's the case for everyone.
Yeah.
The others?
Yeah.
Yes?
Yes.
Okay. All right, look. Okay, good. All right. Let's continue then. Malaika?
Yes.
Good? All right, okay.
Yeah, I'm good.
Let's continue. Let's continue where we were. Okay, so yes, as we said before, this one is about 17 times. So so you're much clearer. Again, we just looking at the accounting equation of it. It's 800,000, which is the asset value, 270, which is the liability side, 530 is the capital. And so therefore you can rearrange this another way. And it is important to note that asset minus liability is equal to capital. All right. So asset minus liability is equal to capital, which is a concept which we would now consider further called net worth. All right. So if you've heard the concept of net worth, you've heard the concept of net worth before, or Michael Jordan net worth, or Alan Sugar's net worth, or Peter Jones' net worth, etc. All these various periods. Wayne Rooney's net worth, Sterling's net worth. The concept of net worth is the individual's total asset minus the debt that they have over a specific period gives you their net worth. All right, and net worth technically is the capital. All right, or their equity over a particular period. As I said before, the 15,000 is a sunk cost, so we would not capitalize it. It's not going to be in the equation at all. And that's it in terms of the theory of the principle. So we've looked at investing in property. What are the strategies? What are the conscious invests? And Okay, so now, I think when I did this some time ago, people were asking about stamp duty. I think recently the government has kind of changed the whole concept of stamp duty. And if you're buying a property for the first time for up to 550,000, you get 0 stamp duty. But if you're buying a second property, if it's your second property, it's 3%. And then over 551,000, it's 5% for your first property, 8% if it's your second property. And then the figures, you know, keep going, 10 and 13 and 12 and 15 based on the parameters there. All right. Now let's look at some questions. So this is your opportunity to apply the principle. I would suggest that you get a piece of paper and you basically do some calculation. So the first question says, if an investor buys a property for 500,000, which is its fair value, with a deposit of 25%, what will be the equity stake in the property? I'll give you a few minutes to do that. You can write it down. Please don't shout it out, but we will look at the answer in a few minutes. If you finish question 1, you can move on to question 2, and then question 3, and then question 4. Are you finished?
Yeah, I suppose so.
Okay. I heard from the others. I'll give you a couple more minutes. Okay, let's start with the first one. So if an investor buys a property for 500,000, which is its fair value, with a deposit of 25%, what would be the equity stake? What's the answer?
375,000. Is it right?
Anyone else? Okay, that's your look. Yeah, that's your answer. Any other? Rose, what's your answer?
I am with him because the deposit 25% would be 125,000 plus the 5%. 130.
No, we're doing one.
Yeah,
it says what would be the equity stake in the property. So what's your answer? Tell me what your answer is.
I am saying 375 as well.
Okay, I disagree.
Oh.
I disagree. The concept of equity stake is the deposit. So it is 125,000.
25.
Yes.
Okay, the deposit.
The principle of equity stake is you deposit.
Okay.
So the 25% of 500,000, which is 125,000. Yes. Yeah. Okay. If fees on the above investment is 5%, what would be the amount based on costs?
What would be the amount paid? So it's 130.
Okay.
130,000, 125 plus the 5%, which is 5,000. So you'd be paying 130,000.
Okay. How did you calculate your figure?
Well, it's 125,000 that you're paying for your deposit, isn't it? And you are going to be paying the 5. Oh, hold on.
No.
Are you seeing yourself now?
If the fees on the above investment is 5%,
yes.
What is the amount paid based on cost?
Yes.
So what's the investment? The investment, is it like 500,000?
Okay, good.
So
therefore, what would be the fees?
So it would be 25,000.
I agree. 25,000, I agree. And why are the fees called sunk costs?
Because those just go.
Okay.
That is dead money.
Yes, it cannot be capitalized.
Yes,
it cannot be capitalized, and therefore, you would not see it represented in the actual asset value over the period. Mm-hmm. Okay. When renting a property as a sublet, what are the factors to consider? And give an example. So if you're gonna go into Airbnb or that are subletting a property, what are some of the things you need to consider?
Well, you have to look at how much you're going to be renting it for.
Okay.
How much you can gain from the sublet.
Yeah.
And then you have to look, you also have to remember that if you, for example, if you're renting for 1,000,
yeah,
you're also going to have fees.
Yes.
So you need to build that in the cost of whatever you're going to sublet for, so that you know that you're going to profit.
Good. All right. Good. And also the rooms, isn't it?
Yeah.
Yeah.
Yes,
we want to know.
Be able to expand.
Yeah. You want to know that you have enough rooms, and also if you can convert some of the rooms as well, that would be important. Mm. And then the permission from the landlord, because some landlords, they would say, okay, fine, only 5 persons in the property, only 4 persons, so you need to get all the permission. So the legality side of it as well is important. Okay, apply the accounting equation to the example in question 1. What would the accounting equation look like?
Asset.
Yeah, yeah, I know it's asset is equal to liabilities plus capital, but what are the figures?
The asset will be 500,000.
That is correct, yeah.
So equal the 375.
375 is what?
That will be capital, so equity.
That would be the end. So it's 500.
We need to make a decision. I'm leaving it up to you.
500. And then the next figure is 150. Then the last figure is 375.
The 375,000 is the liabilities.
Let me just check it out.
Okay, I agree with Jean. And therefore the capital is?
375 plus.
No, 125,000.
Okay, I agree. So
125,000.
Jean is correct.
Yeah,
So,
370 plus 125, yeah. To
yeah.
get it 500.
Yeah. So please remember that the 25% is the deposit. The deposit is always the equity. The deposit is the equity or the capital, all right? All right, so just remember that. When you put a deposit in a property, that's the equity. Your equity stake in the property, all right? That is so important.
Okay.
Understanding that is so important. The debt side of it is the other proportion, all right? And then the asset is the a combination of both the liability and equity. Okay, so the answer should be 125 for the first one. Fees, we said 25,000. I just did an example. So I said 2,000 plus fees of 400, and then there's a 4-bedroom house, and we're renting each room for 800. We could say pounds here, dollars for the Canadians. And so therefore that's 3,200. Therefore initial profit is 800. So that's an example of it. And so again, 500,000 is asset, liability is 375, and capital is 125,000. All right. That's it. Any questions?
No.
We all clear?
Yeah, now yes. Yeah.
Good, good. Well, this is your opportunity now to decide whether you're going to continue with us. We have 3 more sessions to go. So we're going to dig into some of the other concepts in terms of property investing, and we look at examples and, you know, building the whole idea. Good content, very useful information. Some of you may have properties already, but this allows you to understand a little bit deeper some of the concepts, and, you know, build your appreciation of finance and investing and personal finance. So I would like to welcome you on the remaining sessions. You know, well, the choice is yours.
Sure. So are you talking to me?
Yeah, well, we're talking to everybody, not just you. Not just you. We're talking to everybody, not you only, but we're talking to everybody, you know, to jump on board. And, you know, so we're going to have the next 3 Tuesdays, same 6:30. We're going to keep going. And you know, we're going to build on what we've started off with. And the intent is to improve your knowledge of, you know, finance and well, property investing technically, which is kind of a branch of personal finance. All right.
Sure.
But it was a pleasure to have met you, and I'm sure, hopefully, you enjoyed the session as I enjoyed myself delivering it. And,
Okay. Thank you.
Yeah, I did enjoy it, and thank you. It was really interesting for my first time, and like give me the desire to put that down on my calendar on every Tuesday now, and yeah, look forward to share some content with all of you. Yeah.
Good, good, very good. All right, good.
Thank you, thank you, guys. I'm going to be leaving because I need to get me some dinner.
Okay, I understand, Rose, but thank you very much for coming. You have been a good sport, and yes, I'm sure you learned something.
Thank you.
And say hello to the members in Croydon. You know.
Yes, will do. Okay then. Thanks.
All right, then.
Bye, guys.
All right. All right. So all the best, and I'll see you next week. All right.
I will send you a message.
All right. Okay then. All right.
Bye.
Okay. All right. Cheers. All right. Bye-bye.
All right. Bye-bye.